Hi, everybody. Ashish Kumar Chauhan has some of the biggest names behind his career. He's the managing director and CEO of Asia's oldest stock exchange, the Bombay Stock Exchange. This is also the world's fastest exchange and the world's largest in terms of number of companies listed. Earlier, Ashish has worked with India's largest company, Reliance Industries Limited. Before that, he was part of the team that set up the National Stock Exchange, created and managed the Nifty Index, and is known as the father of modern financial derivatives in India. For such a designation, to be a father of modern financial derivatives, a father of anything, you need to be 60 or 70 years old. But as we all know, Ashish is hardly in his 20s. And I say this not because of his physical age, but the enthusiasm, the energy with which he approaches his work, his relationships, his friends, his concern for the economy. It radiates that of a young person. He is more young than several young people that I know. He's clearly the best person today to explain to us just what is happening in the markets. Welcome to ORF, Ashish.
Thank you, sir.
I'll come straight to the point. When the number of coronavirus cases were less than 100, the Sensex crashed from more than 41,000 on 12th February to less than 26,000 on 23rd March. This is a fall of 38% in 40 days. It gave nightmares to a whole lot of households who had their savings invested in mutual funds through equity funds. And then in the next 4 months, the Sensex is up almost 46% to almost 38,000 in 4 months. That's about 9% short of what it was in February. What's going on, Ashish?
See, basically, it's not only in India that it has happened. It has happened all over the world. So we must understand that this is a worldwide phenomenon. Now we have to also understand why this is a worldwide phenomenon. Why markets move so much. Basically, what are these markets? See, there are markets for vegetables. There are markets for refrigerators. There are markets for televisions and so on and so forth. Those are markets for goods. These are what we call markets are actually markets for capital. Capital which produces something else, which means it's for long term. So the assets which have been created will keep on getting you the returns over long term. So whatever you see in terms of the market capitalization of the economy, all the listed companies or otherwise, it's basically giving you a perspective of how much value it will generate in terms of profits at net present value, broadly speaking, as of date. Now, when the market participants, they talk about a company, they worry about a company, whether its profits will go up or down. Of course, if the profits are going to go up, prices go up. The profits are going to go down, then the prices go down, which is known to us. It happens in even vegetables and stuff like that, right? So that is broadly the comparison there is. Now, these stock markets are very interesting because they try to take into account all the information that is available about a company, about an industry, about the economy, about the entire world. And they try to price everything there. So if, for example, if the number of people are growing up in China, and that's going to increase demand, after 20 years, they still take it into account now. So all the information that is available or can be potentially envisaged, that basically is currently available in the price, whatever the Sensex price is, 39,000 or something. Now, whenever a new event happens, which has not been even worried about before, then that's a shock. So that's where what is called black swan event or unknown. If you recall the Donald Rumsfeld framework of unknown or what we call Nasib Taleb framework of black swan. When a black swan event comes, actually very grave. And that's where when the news started coming up, that there was a great virus in China and China had actually locked down some province. People thought it may be just China related issue, but then slowly it went into Iran, then Italy, and then the white world started getting infected. Large part of the wealth is now, of course, in China also, but also in the Western world. And that is where basically the panic started, saying it was not supposed to happen to us. And there were many such things which happened over last 20, 30 years of SARS and Ebola and so on and so forth, we did not kind of spread much. But this started spreading, and that created a panic that we are also vulnerable. And then the comparison started of Spanish flu. 1917, 1918. It seems even India had probably, as per the stories, whether to believe or not, but 10 crore people died. So in India's population that time probably was 30, 40 crore only. So whether to believe or not is a different issue, but large proportion of people died because of that flu. And those things started, once people start worrying, they worry too much. And this was kind of unheard of thing, that how on earth somebody just by meeting you or being 6 feet away from you, or not even meeting you, just in the lift, starts getting this infective disease, which is actually deadly. And that is, I think, what tilted the favor. Everything went down like a dominoes because a new sort of new framework came in to our calculations of all the pundits that were
So Ashish,
defining the price.
the fall is understandable. Any uncertainty, markets don't like uncertainty, business doesn't like uncertainty, there is a new risk that comes, etc. All that is understandable. What is not understandable is that when the cases have multiplied today, the markets have also risen. That is the dissonance in the logic of markets knowing everything and being able to discount the future.
So let me give you that perspective also. So when this thing started happening, you could have seen the Indian origin experts from US and other great universities coming and telling on our television that by July, August, India will have 10 crore infected and few crore dead. And rest of the world will also have some less because they have ventilators, we did not have ventilators and stuff like that. And that is where basically the dissonance actually went the other way around. The pendulum swung so much that a lot of people are going to die. And despite all the cases, number of cases increasing, India went into lockdown completely, which China even didn't do. India went into lockdown, many other countries did partial and stuff like that. But over a period, the market has now discounted the fear of COVID, that it is a fearful disease, but it is not Spanish flu. It doesn't kill 25% people. It doesn't kill even 10% people. It doesn't kill even 5% people. It doesn't kill even 1% people. So what has happened is suddenly from 20, 30, 50% of people getting killed, now you are coming to some 0.01% or 0.05%. So although we are afraid because individually it is still a risk, but on an aggregate basis, they also of course figured out that the societies are able to manage the disease in some ways. And that's where slowly it started going up. But there is another reason to that also. So when it came as a black swan. But once black swan happened, everyone knows there is a black swan now. So people get used to the black swan and they know broadly it acts like a swan. It is like a flu. It's slightly deadly. It works very badly, but it's still not as bad as Spanish flu there is, right? So that was one part. The second part, whenever, if you have observed after 1971, when the gold standard was removed by America, backing the dollar, since then, every government has figured out that when in trouble, print more money. So that's what happened in the great financial crisis of 2009-10. Huge amount of money was pumped in. Before that, in 2001, when the World Trade Center thing happened and the world was looking like going bad, again, a lot of money was put in. Why I'm telling you this is, I mean, there is a joke in financial circles that somebody goes to the Fed chairman and tells him that the Martians have attacked the world, and he will say, pump more money. So all the ills have one panacea, which the policymakers have figured, that is pumping in money or liquidity to ensure that the asset prices don't go down. And just to give you some understanding that 12 trillion plus dollars have been put in till now by US, Europe, Japan, China, India, all of them put together, $12 trillion. India has not put in what I call without reason, but because we have got a package which is specifically to the poor and so on and so forth. But many other countries have distributed money. And that's where this $12 trillion is also taking the prices up, because the asset prices now assets are being chased by the new money.
Then
that's where
what I'm hearing is that basically it's liquidity, excess money in the system sloshing around across global markets that is pushing the markets up, which then leads me to another risk. It is fine in the short term, but then at some point this money will go, and the underlying, where there are still restrictions by several governments, including India, for work. You need to have several preventive changes, preventives in place before you start working, etc. Those are still in place. I don't see how companies' revenues are going to rise unless those very few companies that can work, whose executives can work from home. Once that happens, let us say the factory floor. The factory floor is now it's a risky premises. Now, suddenly, if policy makers open the factory floor that you can say work out there, even with some protections, and some cases begin to rise, again, it's a reverse risk. So at some point, I believe this money liquidity, which is pushing stock prices and creating an asset price inflation today across global markets, will finish. At which point, do you see markets crashing again?
See, for me, one is sometimes we worry, we start with tremendous worry, which we should as elites. But we continue with the worry when the rest of the world has figured out that it's not too much worrisome, right? And so we continue with that single point which we had in January or February, saying this is a killer thing, and 10% people will get killed. Now, even people who are getting infected are not getting killed so much. Why? Because the society has also figured out how to manage it once you get infected. Why I'm telling you this is that portion, we end up, it's like basically the last samurai, the war is probably done, the samurai is still fighting. And so many of us take up that issue and continue to fight. So I have, in fact, there will be waves. That's what people have observed in the past infections also, epidemics also. There might be waves, but as far as the society is able to manage it within reasonable limits, it will continue its functioning. It will, of course, have more precautions. In fact, if you recall, especially since you also stay in Delhi, do you think there is a medicine that has been invented for dengue fever? It is a tropical disease. It is a poor people's disease. That's why it is not, otherwise it's more deadly. It's very debilitating. But we don't worry because it's a white man's disease, or it's somebody's disease which has gone to white men. They are dying. So that's why all of us are taking up. I'm not saying it's not a very sort of bad situation there, but slowly over last 6-7 months, the world, including India, has slowly started understanding how to live with it. And that's for me one part. The second is factories. Factories will have to figure out methods to handle how to sort of protect their workers.
Let me nuance that question a bit. Let me nuance the question. You're talking about factories. You've also recently opened an exchange for SMEs, which means you are in conversations with several SMEs, professionals, executives, promoters, investors. What is their take? Are they taking this risk of allowing the labor to go in? There is a cost to opening factories today in terms of regulatory requirements, in terms of protections to their labor, etc. What are the voices from the ground telling you?
No, voices from the ground are still fearful on how the law, which is still uncertain, will be applicable to them. Everyone is uncertain. The construction workers are uncertain. The builders are uncertain what to do if their workers get something, even when they work in open. And so everyone is uncertain of how this will become applicable. And the fact is, ultimately work has to go on. There are many countries which have allowed work to go on. And so initial, what I call worries, and the lockdown, which was complete, and in a democracy, it's not easy to do. India did it in a federal kind of a framework, was a commendable thing. 70 days, now we are 70 days more. And we are still afraid. We must be, as a society, as individuals, we must be afraid. But slowly, the shops have started opening. Every state wants it, every city wants it, because ultimately they want income, they want jobs, because without jobs, without income, without working, without production, you can't be eating for next few years sitting at home. That, I think, is well understood now. And many countries like America are trying to push much faster unlocking. India is also doing what I call a little more calibrated approach at each state, each city level. And somewhere on the line, we will come to that sort of what I call a very uncomfortable disequilibrium. It'll continue to move, and then so slowly society will figure out how to actually work with it. But we must. We cannot be paralyzed now onwards, at least going forward, and how to handle all the other things. But the biggest issues today are many, but one is the cash flow. Many of the largely affected, let's say, hospitality industry is currently, I mean, they don't know how to even handle it because they start and they have to stop, whether it is hotels or airlines or tourist services or intercity buses. Intercity buses, it's a very bad situation. But even the manufacturing and all, they've started, many of them in rural areas, other places, they've started. And that's why if you see the GST collection of June, and then later on July, when we opened up in June, it blew up because of the fact that 2-3 months sort of backlog was there. But July GST collection was not bad. It was 85,000 crore, right? And for me, that tells you that large portion of the commercial activity has started without us realizing in the entire country.
The fact that we could get food, groceries, etc., all through the worst of the lockdown showed that supply chains were pretty much in place and they were functioning very well.
But for that, we have to also thank the government. Many times, literally, everyone blames government for inefficiency. But this time, they have done exceptionally well.
So let me bring you back. Let me bring you back to the Sensex. Now that if you see the economy stabilizing, if you see factories starting work, if you see services sector going, moving on, then when is the Sensex touching 50,000?
So that for me would still depend on more liquidity, more sort of
liquidity will continue to drive markets rather than earnings.
Not that earnings will also come out of liquidity to some extent, but also newer production, newer things, and there will be companies which will which were earlier also not viable. They might have become completely unviable now, and they might stop. And so you are going to see some what I call destruction of value in certain areas, and that would have happened over a long period. Instead, there has been a kind of a large immediate cut. But in other areas, you will see even. In fact, I was wondering if this corona thing goes away at some point with vaccine and new medicines and other things, what will happen? Will we be all so much more enthusiastic to go out and work instead of 8 hours, probably 12 hours, because we have all been bored sitting at home, broadly speaking, I mean, 8 hours, I mean, throughout the days, we have not gone out of home even once. And so would we be more now outdoorish, work oriented, and so on and so forth? That's what the questions I have. There are many more repercussions of this lockdown, of this what I call great disease that has
a whole lot of social, cultural, psychological repercussions. Let me bring you back to markets. So all our discussion so far has been around equities and how companies will make their earnings and markets will go up or down, etc. But and India has done very well on the equities as well as on the derivatives side. We are right on top on several parameters: speed of less than 6 microseconds on the Bombay Stock Exchange, a wide range of products, currency, interest rate, derivatives. But there is one big hole in the Indian market, which is the corporate debt market. Firstly, what is preventing India from creating this market? Is it policy? Is it regulatory turf wars? Is it that the government needs finances and hence is preventing a rich corporate bond market from coming up? This is across governments, by the way. I'm not blaming the current government or the previous. Second, how would you create such a market on the Bombay Stock Exchange?
See, basically, if you, again, you have to look at it from the historic perspective. How did we come here, where we are? If you don't understand how did we come here, you won't be able to solve the problem going forward in case you think it is a problem. So how did the stock market get created? See, in a very poor per capita income type of developing country like India, there is no similar country in the world which has this kind of thriving equities market. It is actually a very unique market in a way. I mean, if you have it in US, Europe, it is fine, even in Japan, because they are basically developed markets, you know. In India, I mean, China is a sort of enigma on its own. You don't know how it works. Even they probably don't know. But India, working on what I call Anglo-Saxon codes, laws, the methodologies, and having this kind of a very thriving equities market for risk, market for trust, equities market. Otherwise, you can lose the entire thing, right? And if it goes up, otherwise you lose. And that market is thriving. Why the bond market did not come up? As you rightly said in your third point, for very long, the government of India used to be the largest borrower. In fact, in economics, it's called a crowding out effect. That when government borrows a lot, it crowds out everyone else because government is the best credit there is. They can print money.
It also creates a financial repression in its various expressions.
But interestingly, there are very many ways to create financial repression in addition to this, but I will not discuss that today. Why I'm telling you is we came into the situation where the government is not borrowing much under a specific condition. That is the fiscal responsibility framework. That once you started controlling your fiscal deficits, that's where you slowly had a government and even state governments did not end up coming to the market all the time. Otherwise, the Indian budget had no control. They used to just spend, they used to have some budget and they used to spend much more and nobody bothered. Today, that fiscal responsibility framework is actually holding in good state that everyone is able to understand what is going to happen. There might be some plus minuses, no problem, but at least you know where you are, all the data is transparent and so on and so forth. That's where I think slowly the government's needs went out. The other part was that we gave tremendous importance to banking sector. Like any socialist country, we were basically very wary of markets. We were hugely in love with banks because banks, you can actually direct the credit. In stock markets, you cannot direct the credit. If the company is not good, then people will not put in money, whatever. You can't push them to put money in. Of course, you can do PR and other things, but effectively it may also collapse.
So you can only persuade. You cannot push the people.
The second part also is that once you invest, you can't roll over. Banking allowed you to roll over. Once you have a bond market, I mean, when the bond falls due, you can borrow separately and pay this up. But it cannot be that you end up extending the same bond again and again. While as in loans, it could be done. So banks, and we create a kind of a framework that banks never fail. Whatever their mistakes, we will not allow them to fail. They do fail. But we will not allow them to fail. Other things, if bonds company don't pay, it's okay. But the banks, whom you put money, where you put money in, so we create an illusion that bank should never fail. The depositor who is putting money in the bank should never worry at all which bank is putting money in. It's no longer buyers beware. So we have created those illusions which are now going to hurt us, because if you want to actually go further and further, any bank making mistakes, it's now basically the society's problem. And that's what happened to even US. So when people say that privatization is good for banks, but whenever they are in trouble, government has to pay them up. So there are such moral and other dilemmas also. But effectively, we did extreme. And that's where the markets, nobody bothered, because somewhere along the line, people do default. Companies go down under.
How would you create such a market? Suppose you are given the option to create the corporate debt market, which is a necessity, which will also help SMEs more than anybody else. How would you create such a market on the exchange?
See, one thing you must understand is the understanding of credit is not easy. See, the bond investors are very different from equity investors. Equity investors know that their money can go to zero. The bond investors don't want to take principal risk. But when they go and invest in any other thing other than the government securities, they are taking the principal risk. Because the borrower may default. But we have created a framework that you put money in bank, don't worry. So now the bond market you want to create, unless you create a framework or create an understanding in the market that there is a slightly more safer mechanism, which is bank, because it's a pooled vehicle, and there is a little bit of a social stability part of it, which government will have to fulfill. But if the bond markets have to sort of work out, then people have to understand the concept of defaults, how to collect those assets, because when companies default, the assets are behind the bonds. They are collateralized. And that collateral, how fast we are able to collect, sell out, and at least give some money back to the bondholders. From 1985 onwards, we had an act called SICA, Sikh Industrial Companies Act, which got repealed only in 2017, I think, or 2016. Basically, nothing happened for so many long years. And today also, the bankruptcy framework, that is what I'm talking about, is now again sort of non-performing for this year. But effectively, how fast we are able to sell those assets, get money to the bond holders and give it to them will determine, finally, it's the lender. He may also ask for 2-3 more percent or 200 basis point or 500 basis point as we call it. But finally, he knows that he's taking a risk, but not on 100 rupees. If the asset is there, can you sell it? So we have to create those markets for assets, the faster mechanism to give justice to the basically lenders. We can't be giving justice to everyone else except the lenders. We are trying to give justice to borrowers, to the workers, to everyone else except the lender. And lender is the guy with the money. We don't worry about him. How can a modern society function, right? So for me, there are many lacunas in our current way of structured thinking, that ultimately, if we don't take care of the lender, then nobody is going to give money to the borrower. So borrower will also suffer. The bond market will not develop unless we end up basically creating those kind of ideas and also sort of propagating them, saying that anywhere you put money is at risk. It's not that only in this place. Of course, it's more risky, so you ask for more returns. But if it goes down, whatever the assets backing that are is yours, and within few days or few months, you will get your money, whatever we are able to sell. And of course, there should be no corruption in selling that and all those things. That's how I would see that we need to do it. Otherwise, anytime a default happens, market freezes, because then nobody wants to invest in the new bonds and the yields.
So perhaps a classification, a regulatory classification that allows for and puts such bonds into a junk bond category would help. But I think these are more regulatory issues than market issues. Let me bring
again,
you back to
for me,
market.
just to be on this classification part. I mean, classification will achieve what? Nothing.
That investor will know that you are buying a highly risky bond.
No, even after that, but
or a group of bonds that you are buying in a package through mutual funds.
But after that, also, if you don't get the money out of sale of assets, even it might get you 10 rupees out of 100, then what is the point? Right? And our AAAs have failed. So there is an issue of the credit rating also. But for me, if you can't solve signaling is very different. What is reality? What you are saying is signaling is to be done. Signaling, however much you do, but if your reality doesn't match with the signal.
I think an integrated approach, which also includes quicker justice system, faster turnaround times, will also help. Let me bring you back to the equity market right now.
Yeah, new courts have been set up, NCLT, NCLT, all those things are, I think,
let's see how that plays out. Now, questions are often raised that the Indian market, equity market, despite being a 2 trillion plus market in the aggregate, is not deep enough. You look beyond the top 30, 50, or even 100 if you want to stretch it to some limits. And after that, there is no liquidity, there are no transactions, no trades, or if they are statistically insignificant. The stocks are not liquid enough, there is not much happening. So what I want to ask is that how come, and India is growing. So what is preventing large IPOs from hitting our markets? What would you do to deepen the equity market?
No, we have a habit of what I call self-flagellation. We criticize ourselves too much. And we think what we don't have, the rest of the world has. So we think our markets are not as liquid as we think, but America must be so much liquid that it is a heaven, right? So everything which we don't have, if it comes, it is a heaven. It doesn't work that way. A 2 trillion market is a $2 trillion market, okay? And markets has many parameters. One of them is liquidity. But the larger is basically capital formation, wealth creation, and so on and so forth, right? And there, India has done exceptionally well. Let me put it that way. Everyone is allowed to raise funds in the Indian equities market specifically at absolutely close to zero cost in SMEs, startups, and all. I mean, people are raising $100,000 in India for startups through the exchanges. In America or Europe or wherever, if you have to go for an IPO of a startup, it will still cost you $20, $15 million minimum just for merchant banking fees. So you have to raise multiples of that to even sort of raise, while as India has done wonderfully well. And that is where for me, the liquidity, if there is a perception that in the, say America has 4,000 stocks traded, in the 2,000th company, there is tremendous liquidity. I can tell you there is also no liquidity in America also. It is just that in our mind, we believe that there is liquidity there. See, liquidity is a function of how many people hold the shares, how many, what kind of market capitalization is there, what kind of trading velocity is there, and so on and so forth. and it changes from time to time. So some years like ACC in 1991-92 used to trade a lot. Today it may not be trading that much. So its liquidity has come down. But is it its ability has to generate profit as the company has come down? Probably no. And so on and so forth. Why I'm telling you this is, we have the tremendous perception that if this is not there, it should not work, but it's working. I remember one of the centuries of Sidhu, first century of Sidhu, had no fours, I think, or very little sort of boundaries. And commentators were saying, but this is a century, but we don't count it much because it's not having four. I mean, it's not having boundaries. He should have hit boundaries. And for me, that's a probably later on he was also removed, and then later he came back as a slightly more attacking batsman. But what good he did in that century, we want to forget because we are criticizing for the, probably came from some state which was not in the highlights those days. And that's how I see it. So we end up.
Ashish, let me rephrase the question. Over the past 3 years, maybe even 5, I don't have all the data with me right now. It's more intuitive and from memory that I'm talking. The number of investors, households that are using systematic investment plans to get into equity funds has multiplied from about, I think 10 million to 100 million per month to $1 billion worth of equities per equity funds per month. Clearly, there is a whole lot of new liquidity coming, but the money is going into the same, what I mentioned as the top 30, 50, or at the most 100 stocks. What happens when there is a steep fall? Let us say, if you look at your own index, BSE 500, for instance, you will see the liquidity parameters are nowhere close to where they are in the top 100, and which are in turn nowhere close to the top 30. Obviously, the Sensex companies will be traded more. But I think the gap is increasing by the day, while money of investors who are coming with, to create wealth, to put their savings in it with a little bit of risk and a whole lot of financial literacy is increasing. And I see a dissonance there, and I think not enough IPOs are coming, large IPOs. Not enough of them are coming in the market. What do you say to that?
See, basically, I'll just give you one, I'm going to ask you one question saying, what do you think is India's total trading volume in a day, only in equities and equities derivatives put together, on a peak day in a month? Any number you have in mind? Just take a wild guess.
I don't have a number.
Just take a wild guess.
Say,
in one day, how much India's equity and equity derivative, because both are proxy for each other, how much do they trade?
Say a few 100 million.
They trade 41 lakh rupees, 41 lakh crore rupees in a day, okay? In a peak day.
The question is, do all stocks do that, or only a select few, the top 50, let us say?
But that is true for America also. Why I'm telling you this, I'm just saying 41 lakh crore is pretty much India's GDP is getting traded every 5 days. Understand? Just in equities and equity derivatives, both are proxies, right? Why I'm telling you this is, our perceptions are far away from realities, and there are worries about over trading now, not under trading. And trading doesn't get you anything. If you run on treadmill, which is what I call it, you don't reach anywhere, right? So liquidity is basically a good function. Running is better than not running.
So you're not worried. You're not worried that about the allegations or about the questions that the Indian market is not deep enough. That doesn't give you sleepless nights.
The other way around. I am more realistic. See, people who ask these questions are idealistic. They want ideal liquidity, ideal this, and we know only Prabhu Shri Ram had ideal qualities. All of us are sort of different these qualities or lack of qualities, right? And that is true with every market, every company. And if we don't realize that every company should have $1 million or $1 billion when I want to sell, I should be able to sell and buy when the company doesn't even have $10 million market capitalization. So that's where I always.
But Ashish, that how would you then react to the fact that China has X number, I think, what 100 unicorns. India has about 6 to 8 or 10. So the whole idea of unicorns as a currency of, well, I don't want to narrow it down to a trade, but definitely it's one of the important parameters of a strong, vibrant financial and economic sector in India is lagging. It's lagging a lot behind. Don't you think it's to do with fewer listed deep companies?
this unicorn thing is a very interesting thing. None of them get listed on exchanges. Okay, very few, very few. They are unicorns in the minds of people who are trading among themselves. They are not listed companies. And unicorns are basically for valuation, which are making huge losses. Even in China, some of them have started making profits. And China is a very interesting, being in the market, I tend to also talk to some of the people there. China has a very interesting framework of marketing those companies. The merchant bankers force, literally, one of the issuers told me, merchant banker forced him, when his company got listed, to take stake in the next 5 issues. So it's like a cycling of work.
Maybe China is the wrong example.
The government is China. Whenever the market goes down,
yes,
government A team comes in and buys $200 billion of stocks. Whenever LIC buys, we start criticizing it, not the government. While China, pretty much large portion of the market is now owned by government, and the other side is also government company. So it's a very different market.
You mentioned some time ago that $100,000 worth of money is being raised by startups on the exchange.
Yes.
That's an interesting number because so far the perception is that most of this money is happening, or these trades are happening outside the exchange, outside the formal exchange. It's happening through private equity or informal finances, angel or tier series 1, series 2, and so on. How do we onboard them? And you're already trying to do that through the SME. Has it taken off the way you had planned it to? Do you see greater potential here? Are we going to see, well, to use a bad word now, unicorns coming out of your SME index, SME exchange?
Yes, why not? See, I'll tell you, the SME started in 2012, March. Okay, today it's 8 years over. And we have raised the funds for 300 and around 30 companies till now. Each company has raised average 9 crore rupees. So effectively, we have raised close to 3,000 plus crores. And their market capitalization today is around, after the drop, is also in the range of 18,000 crore. So many of them have done well, and many of them have graduated, almost 20%. More than 65 have gone to the main board. What happened is, we realized while talking to the young entrepreneurs that they don't like to be called SME. They want to be called high tech or whatever. So we created a new platform called Startup. SMEs in BSE have slightly more difficult hoops to go through. They have to comply with many conditions. Startups have lesser conditions, but we also want to attract them. And although we, what I call this perception that every engineer in India, when he has an idea on the napkin, he starts getting money, it is not true. It is a perception. It's what I call magic of public relations and media relations, that newspaper give you about something which is $1 billion market cap is also called a startup. It is so beautiful. We like children, right? And $1 billion is not a startup. Basically, 10 feet man is not a startup, right? Or a young kid. But they've put it in our mind that this is called startup. Most people are not getting any money from NGL, nobody, right? And that's where we thought it's better to create a startup platform where we will nurture the young businesses. And of course, there are people who will be able to give them money. Minimum lot size is 1 lakh rupee. Around 6-7 companies have come over last 1 year. During even the COVID period also, few companies have come. So I have no doubt that some of them will come. Of course, they will not have billionaires sitting behind putting, or $1 billion funds sitting behind, sort of putting a lot of efforts behind them and money behind them to make them even look larger. These guys will be normal people. Chances that they may not become billionaires, but they will create some good skills for India, good companies for India. And who knows, some of them, like Infosys, when it came in 1993 or 94, whenever it came, you know, the issue also devolved. No, not many people actually.
That's right. I remember.
And for me, that is my $1 billion company. It's a proof. I don't have to, and literally nobody provided them funds those days also. And those kind of companies might not be provided funds today also. But that doesn't mean they're bad. Many of them will grow up. And what we need to do, my favorite topic nowadays is what I call capitalism without capital. Earlier, we required a lot of money for creating a lot of money, more capital for creating capital. Today, you require a lot of brains, very little capital. If I can somehow get people to fund our youngsters, then our current unicorns, which are almost always largely owned by foreigners, so wealth these people will create, foreigners will get the benefit. Whereas here, If Indians invest in our youngsters, when these companies grow up and that wealth gets created, it will be shared in Indians.
Okay, so I'm being told that time is up, but I'm still going to push with a few questions, and let's do it very fast, Ashish. For companies to enter the Sensex is a tough journey, but I believe staying is even tougher. And in the age of constant disruption, almost impossible. It's like a treadmill. So in the 20th century, all you had to do to stay in the Sensex was to keep growing your sales, your profits, keep adding value. In the 21st century, that model is giving way to innovation on the positive side and disruption on the negative. So how can a company stay on in the Sensex for decades? Or is that a rhetorical question, that there is no such company available?
Not at all. There is a company, you have seen Reliance. There are
Reliance is a class apart. It has transformed itself from an energy company to a telecom company, and it is continuing to grow. But Reliance comes once in a while. But in general, how would a company stay in Sensex?
No, every company has to evolve, going forward faster. Future is coming faster than the past, right? And so there are many companies still in Sensex, even now after 40 years, but very few, as you rightly said. And for that, they will have to continue to reinvent themselves, renovate themselves, continue to be on a treadmill, and treadmill is running much faster than we are used to. So it's a very tough thing, and you'll have to also probably go into next treadmill, which is actually going to take you into a different direction, because it cannot be the same business.
Do you think that this is the death of what is known as core competency?
In a way, you can move around in your newer areas which are adjacent, and keep on taking advantage of your past sort of distributors and past other ecosystem which you have created. So it's not all bad. The past is not all bad. Past is why we are here. So you cannot wish away the past, but you have to create future faster. And that's how I see it. It's not necessary to go completely like Reliance.
What is that skill? What is that skill which is portable across industries and which can help companies through disruption? What is required? I mean, yesterday it was commodities, then it became some IT, then it became FMCG. Now it is telecom and software. Going forward, it could be AI, it could be neurosciences, biosciences. What is the core competency left here? Is it a state? Do companies have to be constantly learning, changing, investing?
No, it is still core competency. For me, your ability to see the future trends in your industry, your adjacent industries, and use the newer technologies which are coming not only in your industry, but also other industry. And the long time you have to buy what I call a lot of options or a lot of lottery tickets. Some of them, if they grow up, because you work hard, because in lottery tickets, you have nothing to do, buy and sit. While as here, you buy lottery and you have to work hard on that. And if you have taken the right bets, then you may grow up to be like 10, 20 times, what I call non-linearity. It is no longer linear. What you said about profit increase, this increase, that increase, 15%, 10% is linear part. The non-linearity, how do you get in your business? And that is again long-term. It's not short-term. You don't become a Larry Page or a Mukesh Ambani one day. It is hard work of many things, many situations, but also gumption, courage, vision, everything, right? So that's how I see it's you will have to continue to reinvent fast, and every company which has survived long have reinvented themselves many times. It's not that they didn't. It's just that they will have to even, and the competition is coming much faster. So earlier, there will be few competition. Now, pretty much every business is facing that larger, faster, better competition. And that's how, because you have a legacy, it helps you actually in many ways to reinvent yourselves.
So there is no rest for corporates if you want to stay in the Sensex.
It's like riding a tiger. It's like riding a tiger. It's a very uncomfortable, but if you get down, it eats you up.
Yeah. So corporate refugees from China are still choosing other countries over India. Some hundreds of $1 million has come to India, but the billions, the big numbers are still not coming to India. They're going outside, except 1 or 2 or 3 or 4. What's happening? What is the problem?
See, basically, when those guys come, anyone from abroad, they are not here to learn about our regulations, our basically different layers of inspectors, different tax systems and all. They are here to do business. They want to manufacture something. Some of it will be sold here. Some of them will be sold outside. And this supply chains are not local now. They are all connected. Some part may come here, some part may go in Vietnam, some may go to Bangkok, then come back, and so on and so forth. So somewhere, these are all interlinked, interconnected. They want faster land, faster permissions, faster ways of doing things, and no labor issues, no interference by inspectors. So we need to basically, what I call, create a country which is actually doing ease of business for and promoting the companies to come to their area, rather than saying that if you come, once you I'll make you come and then I'll start sending this and that guy. And so for me, it's very important for us to understand that those guys have a competitive framework in, say, Vietnam, or in, say, Mexico, which is even next door. To bring them here will require tremendous amount of mindset change.
So let me put some numbers to what you are saying. There are more than 1,500 laws that govern doing business. There are more than 69,000 compliances at an aggregate that companies have to follow. There are more than 6,600 filings per annum that companies have to make. The compliances change at the rate of 2,000 to 3,000 per annum. There are 13 inspectors in the labor alone that can enter your factory and do what they like, ask whosoever, whatever questions they want, stall business. This is creating a huge regulatory cholesterol in our economy. How do we clear this? So we all know the problems. You have highlighted it. I have given numbers to it. How do you think this regulatory cholesterol can be ended?
One is we have to identify, which I think somebody has done a good job of identifying all this. Then we need to figure out what is the benchmark against that in the modern world. Which are the best countries? Really, not and even in details. We need to figure out, and we have to do better than them. What we bring to the table is huge amount of labor, huge middle class, and growing, and young people. And so they will not have a labor prices going up. But what we need to give them is an ability to come in, move out fast. So we need to do basically what I call customs reforms, judicial reforms, tax reforms, land reforms, labor reforms, administrative reforms, every reform that is possible. And some of them are in center's hand, some of them are in state's hand. The center can do its job, allow states to also do a model kind of a code, so that if they adapt fast, some of them will not adapt because of whatever reasons they have, but some of them will adapt. And if they end up getting newer jobs for their people, I'm telling you that competitive federalism has to kick in, and kicking for the right reason, not for the wrong reason. That is to get jobs for the people, to get industrialization done in the right way. And that's how I would put it, that there is huge amount of work required. We have come a long way from pre-91 to now. But when we did what we call liberalization in 91, we only removed the license Raj. We still kept the red tape. The red tape has not gone. All our files still have red tapes. And we have too many files, as you rightly said, so many laws, and we have to come out of that, make it modern, make it easy, but still ensure that the country does not get spoiled in terms of the environmental and other issues. But jobs is our largest issue in next 20 years, and we must go towards creating jobs.
Last word to you. What will you tell a person who is in his 20s or in her 20s? Would you ask her to invest in India, set up an enterprise here, have a bright future here? Or if she is talented, do you think it's better that she goes abroad to an easier place where it is easier to do business, create value, create wealth?
See, when I look back at my own life, when I came out, it was the worst time to come out of the college. 1991, I came out. Okay, and we had severe balance.
I would say that is the best time to come out. That is when you are a child of liberalization, just as I am.
Yes, both of us. And but if you look back at those anxieties, those days, they were really much worse than what we have today. Today, India is so much more confident. It's not funny. We had no exposure. We didn't even know. We used to think all white guys are brilliant and we are all stupid. Today, we think the other way around because we have that exposure. We have seen them that most of them are like us. There is nothing different. Why I'm telling you this is, today's India is fully equipped to take on the future. Literally, there is no other country which is equipped, because the next wealth is going to be created out of technology. My understanding is that the technologies waves are coming faster. Next 50 years will create more wealth than that has been created in last 10,000 years. We missed out last 1,000 years of wealth creation. Today, we are beautifully poised. We have young population. China is old, Japan is old, Europe is old, America is old. There is no large country like ours, which is young, which is technology oriented. We don't go look back. We don't go to 500 years back or 1,000 years back. Although we may appreciate our history and legacy, but we want to move forward as a country.
What's your advice?
My understanding is that next 50 years will create $360 trillion of wealth, out of which India, being 17 to 18% of world population and 20% of young population, if we create 25% of wealth that is going to be created, $90 more trillion will get created. India is already $9 trillion. We'll create, at the end of 50 years, we'll have probably $99 to $100 trillion minimum. And world will have probably $700 trillion wealth. We'll still be 15% of the wealth and 20% of world population or 18% of world population, but we'll still be middle income country, not a poor income country. So for me, the growth, if you want, this is the country. If you think the technology is going to change the future, which I have no doubt about. Past, whatever happened also happened due to technology. We got subjugated because of technology, from Mughals to Britishers. Technology is the only change that happens in the world. And we are, first time in the modern history, last 1,000 years, we are greatly poised to take advantage of that. And India will take advantage of that because we have young people who are oozing with that confidence, who want to create something good for themselves. And that labor, that enthusiasm is going to take India forward. All me and you, we have become what I call the past. The future of India is yet to come.
I may be the past, you are still in your 20s. And I believe that the person whom you're talking about hasn't yet met a bureaucrat or an inspector. So to dampen her spirits. But anyway, on that extremely positive, optimistic and hopeful note, thank you very much, Ashish. You will be called again here. We look forward to having you again. Thank you very much. Namaste.
Namaste.